India is expected to move up from its current 5th rank in terms of GDP to 3rd by 2028, as per the IMF. One of the key essentials for GDP growth is infrastructure development. India has spent $7 trillion on infrastructure over the last 9 years. This number is likely to repeat itself in the next 6 years. In the budget of financial year 24, Rs 10 lakh crore of capex was allocated towards infrastructure development. New age sectors are emerging under the infrastructure segment, namely data centers, green hydrogen, coal gasification, electronics, EV charging infra, and 5G capex. If we look at the NSE 500 companies X of financials, the improvement in capacity utilization and ROE from current levels is expected to be similar to the phase of financial year 03 to financial year 08. Real estate is the other key contributor to economic growth and employment generation. We are witnessing improving demand in the residential segment, leading to a decline in inventory. In calendar year 2023 till date, the mid and small cap indices have outperformed the Nifty 50 and Nifty 500. The top performing sectors have been auto, PSU banks, FMCG and infrastructure, while the laggards have been private banks, metals, IT and oil and gas. If we look at the ratio of mid-cap 150 index to the Nifty 50 and small-cap 250 index to the Nifty 50, the mid-cap ratio is trading at its peak, while the small-cap ratio is relatively reasonable. Earnings growth was in double digits in each of the last 3 years, and the trend is expected to continue in financial year 24. Temperature gauge index continues to remain in the fair value zone. For incremental investments, we continue to suggest 50% deployment immediately and 50% to be staggered over 3 months while being able to accelerate deployment during sharp corrections. Based on trailing 12 months earnings, Temperature Gauge Index suggests that large cap valuations are still in fair zone. We recommend to adopt a complete staggered approach for select mid and small cap strategies across MF, PMS and AIF platforms. The U.S. Fed's rate projections suggest that the Fed fund rate is likely to trend lower from current levels of 5.25 to 5.50% to 3.5 to 4.0% by CY 2025. In the latest policy, the RBI maintained no change in rates. Domestic core CPI is witnessing a declining trend, and is expected to ease gradually toward 4% by March 2024. These factors suggest that domestic interest rates have likely peaked, and there is a reasonable to high probability that domestic 10-year G-Sec yields are likely to trend lower from their current levels over the next 1 to 3 years. Going forward, we recommend to increase duration in the fixed income portfolio, so as to capitalize on the softening of yields in medium to long-term period. 65% to 70% of the portfolio should be invested in combination of high-quality like G-Sec and AAA equivalent roll-down strategies of 7 to 12 years maturity funds, and equity savings funds, which aim to generate enhanced returns than traditional fixed income, along with moderate volatility through a combination of equities, arbitrage and fixed income instruments. To improve the overall portfolio yield, 30% to 35% of the overall fixed income portfolio can be allocated to select high-yield NCDs, private credit strategies and REITs, InvITs. For liquidity management or temporary parking, investments can be allocated to arbitrage ultra-short-term, minimum 6 months, liquid, 1 to 3 months, overnight, less than 1 month, strategies.